Yes. So now it's recording. Good. Uh, so this is what was the the goal of the whole course, and I'll just walk you through with. Right. So we went through, understanding stockbroker, company, sectors and industries, then these terms: Sensex, Nifty, index, investment, IPO, dividend, bull market, bear market, market price, book value. Book value is something which we will cover today again. Okay. Market capitalization, asset, liability, these things will be covered again today because these are part of the balance sheet. Then balance sheet, the difference between trading and investing, portfolio, blue chip stocks, SEBI. So people who are joining today for the first time, you can connect with me offline if you want to understand these topics, right? What is risk, hedging, fundamental analysis, technical analysis, trading versus investing, valuation, and the new age trading techniques. So this is what we covered on day one, and I'll move to what we covered yesterday. So as from day one, I'm telling you that investing into stock market is like investing into others businesses, and every business work under certain sector or industry, and these industries belong to certain economy, right? We are living in Indian economy, we do businesses in our Indian economy in one or the other sectors. So yesterday we covered about the Indian economy and some interesting facts and figures, which I collected from internet, from the website of IMF or website of World Bank. And they told us what exactly is our GDP. I explained about what exactly is GDP, and I also explained what per capita GDP is. And then we came to certain calculation where we got to know that it will take us 40 years to beat America, United States of America, in terms of surpassing them by GDP. And there were some calculations, so you can go through the video and understand that. And there I told you people that the power of compounding will work. Okay, so even the rate at which we are growing and the rate at their economy growing, the only reason we'll be able to beat them in 40 years is because of the power of compounding. So we at the early stage economy, having bigger rate of growth than what a mature economy like US will have, right? So it's because of the power of compounding, and the power of compounding only work into investment. This is what we will understand today again when we will learn about the valuation. Then we went ahead and tried to understand different sectors of our economy, so which is categorically divided into three part: agriculture, industry and services, where again some interesting facts and figures were there to share. One was what is the contribution in the GDP and what kind of workforce who are employed into these sectors, where we saw that services are giving 50%, 57% of the GDP, employing just 27% of the workforce. So and within these sectors we picked up one sector and dissected. So we got to learn briefly about these sectors. So agriculture, pharma, electricity sector, education, telecom. We briefly went through these sectors and then took one example and did one case study, that if one industry has grown from 1.2% to 7.5% in terms of contributing into the GDP, what exactly has happened in the shares of those sectors. And there we got to know that these share prices, these companies has given phenomenal return. So before going and choosing into which company I have to invest into, if you really want to win the race, if you really want to make some good money, then it's also about foreseeing which sector is going to work in the next 10 years or 5 years, right? So this is what I try to correlate between why we were trying to learn economy and different sectors, just because we wanted to come down to the bottom line, which will talk about companies into that sectors and their performance. So I asked you people to do a small exercise where you will try to do the similar calculation of your sectors, that what exactly has happened, what kind of return that sector has given. And then we did a case study of the IT industry where I tried to show you people a very good company called IPsoft, who is going to change the future of the IT or IT enabled services, which is where I introduced you with Amelia, their most human AI, which is capable of doing the job of 100 production support engineers into IT industry. So this is the interruption. This is the disruption which gonna happen, which I foresee as an analyst. Okay, and I see a threat into the IT industry. So these tech companies are supposedly, should have done a lot of innovation in the latest technology, but they failed there, and I see this as a threat. Right. So it's about making certain judgment based on your own intelligentsia. So this is what we try to do as a case study and see whether the similar industry which has grown at 30% CAGR in last 10-12 years, whether they will grow at the same rate or not, right? So fundamental study is more about understanding economy, understanding industry sectors, and then the nature or the disruption which is going to happen into that industry, right? So till now we have covered these. You also seen the different aspects of the fundamental research, and then we also try to question one thing, that whether we can be a fundamental researcher or not, whether where because a lot of people have misconception that this is job of a CA. But as I explained, you people know, anybody can, if someone is having a good acumen about judging things and know 2 plus 2, doing 2 plus 2, he can do it, because at the end of the day it's all numbers, and this is what we'll go through today. So continuing the same thing, like where we left, where we wanted to understand what exactly is Nifty and what is valuation, we'll resume the class from today. Okay, so till now, so sorry for the old participant, and I'm taking a little time coming directly to the presentation because I want to entertain the new participant as well. So, any question till now, people who joined today directly? So, I would like to ask Shruti. Richa is a new participant as well, and then my good friend Anant. So guys, do you think anything which you want to ask here, or are you comfortable? So, today class
Yeah, hello.
will be independent. In fact, everything which I'll explain you will be. It's good if you know these basic things. It will create more interest. Otherwise, the course is designed in such a way that even you independently join today class, you will understand it. So, as a teacher, I have this duty to give you that confidence that don't worry. Everything which we will learn today will be very, very simple things. But still, if you have any question, any doubt, you can ask me. Yeah, Shruti, you were saying something.
Yeah, can you just brief once again on Nifty? Actually, I want to understand. I just have an superficial
Yeah,
idea, but I want to know it in
yeah. So we haven't covered. We'll start with Nifty today. Good news.
detail.
Okay, we'll start the class with Nifty. It is not being covered. Okay, so fine. Let's move forward with today's class. So from whenever we talk about the stock market, you know, all of us have heard at least two terms always. One is Nifty, one is Sensex. So from my childhood, also every time when I watch the news, and foreseeably, obviously, as a child, DD1 used to come, and news was something which was observed, listened only by your parents. So in last 2 minutes in news. The reader will read it like आज सेंसेक्स 200 पॉइंट ऊपर चढ़ा या 50 पॉइंट नीचे लुढ़क गया. So I belong from North India, so it was always a Hindi news channel. And so these two terms you people always have heard. One is Nifty and another is Sensex. So Sensex or Nifty are indexes. Okay, so let's try to understand one thing here, very very small thing. So you people, every time you fall sick, you measure your fever, right? So and then when you measure it by a thermometer, if you find it that it's 101 degree Fahrenheit, you you confirm that you are sick, and it's little concerned, you are concerned about it, right? When it goes to 104, you are more concerned about it. So And when it comes to 37 degrees Celsius or anything above that, you are again, concerned about it. So you have two kind of measurement. One is Celsius, another is Fahrenheit. Nothing to do with Nifty or Sensex here. But what I was trying to tell you is you always need a reference point to judge things. So when we say I'm good, it don't define how good I am. I have to define it by taking certain reference, right? That I'm good because I'm better than Anant, right? Who is my batchmate who has joined here, just to give you example. So the some references needs to be set, right? And this is what the stock market also has to do about uh, their performance, right? So that's why they started index. And the stock market index should capture the behavior of the overall equity market, right? So when they were creating index, they named it. And one of the most common index what was created was Sensex. So what BSE did was they took 30 companies. So as I explained you people, there is economy, and within that economy you have different sectors and industries which represents this economy. Okay, so now when we are talking about the stock market, this stock market should also represent one economy, right? So that's why when you want to represent the economy, you would like to plug all the sectors into one basket, and then within that sectors you want to pick up all the good companies or the bigger companies which is having good liquidity inside them. Liquidity means where a lot of buyers and sellers are coming and transacting, right? So when you put them all into a basket, it start representing or giving the behavior of the economy, and that's how you create index. We'll go further and try to understand it, but for at this point you just try to understand what is index. So a stock market index should capture the behavior of the overall equity market. Movement of the index should represent the returns obtained by typical portfolio in the country. Now I'll go to NSE website. So Nifty is the index of NSE, and Sensex is the index of BSE, right? So Sensex has included 30 company and Nifty has included 50 companies. So we'll go to NSE website and try to see, in the real time what exactly is Nifty. So this is NSE website. Okay, 95% of the transaction of the stock market in India happens through this company NSE, right? This exchange. BSE is laggard now. They were the first to open, but NSE has taken won the race in terms of having maximum number of companies listed with them, maximum number of people coming and transacting here. So I'll open and show you something. So let's say this is Nifty 50. So these are the list of those 50 companies. Okay, so what you have to do, you have to go to the live market, equity stock, and you will see Nifty 50, right? So this is Nifty 50. This Nifty 50 is nothing but 9916 here. The last traded price of this Nifty 50 is 9916. And this is the same number here also, right? 9916. Now, this is going 36% down today, right? So here, what you can see that some of the shares have gone up, some of the shares have gone down. And the resultant is, it is down by 36 point or 0.36%. Okay. Now, if we design a Nifty, we come to know that, so if someone is holding Hindalco, only Hindalco, he would say, okay, market was up today because my share is up. If someone is holding L&T, for him market is down, right? So nobody will get a clear picture what exactly is where exactly market is moving. So for that we should have an index, and that index should represent that specific portfolio which we are creating. So the base portfolio of any exchange should be like where you are including the major sectors or major industries of that economy, and that's how it will represent the complete picture of where exactly market is moving, where exactly the economy is moving. So we'll go and try to see what has been included into Nifty, right? So Nifty 50, So Nifty, so don't worry, guys. We will calculate how exactly Nifty 50 has been, has gone 36 point up, or someday it has gone down by certain points. So, but before that, let's understand. So when I said index is needed to take a reference point to check whether it's performing in the positive direction or in the negative direction, right? And Nifty is nothing but a index. Okay. So what exactly Nifty 50 means? What are the sectors they have included? So they have included these 12 sectors. Financial services. Obviously, if the services sector is contributing 57% into the economy, it was but natural to take financial services and give it a good weightage. So the weightage of financial services is 35.73%. IT again comes into services, okay, and it is 11% of the weightage. Energy will come into industry, but it is having a weightage of 14% because that also represents around 27% of the economy, 26% of the GDP, right? So similarly, you have these many sectors. So financial services, energy, IT, automobile, consumer goods, metal, pharma, construction, telecom, cement and cement products, services, media and entertainment. So these are 12 sectors which has been taken into consideration, and then from every sectors, two, three, four, five different number of companies has been taken. We will take that sheet. I have downloaded one sheet from NSE website and configured it for you people to show you what exactly is their exact weightage and what are the companies name which are there into Nifty 50 and from which sector they belong to. We will open that sheet later. Hi Amar. So a new participant joined. Amar, there was some noise problem, background noise from him. Okay, Amar. So I have put you on mute. If you have to ask anything, you can type in the chat section and you can ask. Okay, or you can raise hand also. I'll see here and then I'll unmute you because there's some background noise coming from your side. All right. So what I was explaining you about the different sectors which has been included into Nifty and their weightage. Okay. Now what was the criteria to include those companies within that sector? Okay, so this is again a snapshot taken from the NSE website. Okay, so this is what they describe. Market impact cost is the best measure of the liquidity of a stock. It accurately reflects the cost faced. So let's understand what is impact cost. It is an important thing to understand, and that's how I'll be able to tell you people that why traders tend to lose money into the market. Okay, so how, okay, before that let's understand one thing. Mm, you all understand buy price and sell price, right? So in every market there will be one buyer and there will be one seller, correct? So let's take this example, and the example what we are discussing is about the impact cost. What is impact cost? Here we see. So let's say Reliance share you want to trade or you want to buy, right? So let's say the last traded price is 1000 rupees. So we have something called order book. Let me show you that. So here we have Reliance share. So there is something called order book where people who want to buy and people who want to sell, they 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 get represented on that order book. So in order book what happens that five best prices for the buy got listed on the left side, and 5 best prices for the sell should be listed on the right hand side. And every time when the buy price and sell price matches, what happens that the trade happens, right? Let me better open an Excel sheet and explain you about the order book. So let's say here is guy 1 who want to buy at 1000 rupee, and there is guy 2 who want to sell it at 1001 rupee, right? Then the guy who wanted to buy cheaper, let's say at 999, will be listed below him, and the guy who wanted to sell higher than 1001 will be the second guy on the list on the seller side, correct? Similarly, 1003, 1004, 1005, 3, 4, 5, and again 3, 4, and 5, 998, 997. Obviously it don't happen it like this, but just to give you the example. So this will be called order book. In order book you will have 5 best buyers. So this trailing could be much bigger. So there is some guy who want to buy at 980, he will be also in the queue, but where much below. So what exchange will show in the order book is the top 5 buyer and top 5 seller, buyer in the descending order and seller in the ascending order from top, right? And so this guy want to buy at 1000, this guy want to sell at 1001, right? So either this guy has to come to 1001, revise his price, or some other new guy has to come and say that okay, I'll buy at 1001, or this guy has to agree and sell at 1000, and that's how the trade will happen, right? This is how the trade happen. Buyer and seller should mutually agree on a single price. Now what we were trying to understand from the order book is basically the impact cost. So the difference between buyer and seller, so let's say this guy is desperate to buy, correct? Then he has to buy at this rate, or let's say this guy is desperate to sell, he has to sell at this rate, and he has to sacrifice this 1 rupee. Okay, now this 1 rupee is what percentage of 1001? I think the 1001 1% will be 10 rupees, so it will be 0.1%. Correct, guys, if I'm not wrong? So this 0.1%, so maximum time, you know whatever is the difference between buyer and seller will be considered as the average impact cost. So this is what NSE says about including any company, that a company which is not having, is having less than 0.5% of the impact cost for 90% of the time. For the basket size of rupees 20 million, 1 million is how much? 1 million is 10 lakh rupee, 20 million means 2 crore rupee, right? So 20 crore turnover should be there, impact cost should be 0.5% for 90% of the observation, right? So if any company which is showing this behavior, they will be included into Nifty 50. Obviously, there are some more rules, right? So are you guys okay with this? The impact cost, everybody? That what exactly? So let's say uh, the price of the seller is 1006. Here the impact cost will be 0.06%. Now, why it is important to have lesser impact cost? Because what NSE want to see that liquidity in the share price should be high, so that if anybody want to buy or sell, he should not feel stuck into the pricing game where they are not able to buy, get the buyer, or the buyer is not able to get the seller. And so when you want to buy, or the gap is very high, so to bring the liquidity into the system, you should have the lesser impact cost, and the more the liquid stock will be, it will be considered one of the best investment, because there more people will come and participate, and that's why the liquidity cost is less. So this is what I was trying to explain you people. I want to pause here and uh, tell all you people about one fact here. So from day one, I'm telling you that trading and investing are two different art and science, where unless and until you are you are having certain foolproof methodology, or something where you have backtested a model, it's very very difficult to make money while doing trading. This is one of the reason intraday player always lose money. They try to do multiple transaction, and every time they do, they are in a hurry. And if they are a buyer, they have to buy at a seller price, and if they are a seller, they have to buy at a buyer price. You know, the whole stock market will not give you a return more than 20-22%, right? So, and if you go and keep on giving 0.1% 10 times in a single day, what kind of money you are spending? You are spending almost 1% in the impact cost throughout the day. So that's why so this is one of the reason I have observed that most of the intraday player always lose money, and that's why I discourage people doing that. And that's why we have named this course Be an Investor, where you try to fundamentally understand good companies and invest them into long term to make your wealth the way you make into real estate, gold, or fixed deposit, right, where you have certainty about the income. So if you treat stock market also as one of the asset only to create wealth, trust me, it will not disappoint you. Only thing is you should know the certain basic rules of the game. And every time you try to trade or time the market, there are so many hidden agendas which will always, work against, not in favor of you when you are an intraday trader. But yes, traders make money, but that science has evolved over time. I explained to you people how, having two phone calls and arbitrage between two exchange was a smart trading technique. How these days high frequency trading is a smart technique. So someone coming from a engineering background, no finance and mathematics and statistics and a good programming language, having a good command over the programming of high frequency, those people can go and execute trades profitably. Some people are doing it also. But yes, it's a very highly competitive field. So unless and until you are not getting into there, those people also have the role into the system, because they bring liquidity. The traders bring liquidity. So if you are working for achieving something like that, yes, you can do that. Otherwise, try to stay as an investor. This is one suggestion I have. Okay, so we'll close this window and go back here. So one of the eligibility criteria was impact cost should be less 90% of the time for 2 crore volume. The company should have listing history of 6 months. So listing is what? Coming first time with IPO, right? So you are a private limited company, you want to go public and raise fund to for your business expansion or whatever need you have, and that's how you come with the IPO. So Nifty 50, any company in Nifty 50 should have a minimum 6 month of history, right? So someone who is coming with the IPO today will be included into Nifty 50 only after 6 months if it satisfy other criteria, and one of those companies don't satisfy this criteria and fall out of it. So that is called the index rebalancing, which NSE does every 6 months. So every 6 months they analyze the whole market, all the stocks, and if they find that certain stocks are not fit for that criteria, they push them out. And if they see that some companies have performed better and having more holding from the maximum number of clients, more free float market capitalization, they bring them into the system of Nifty 50, right? What are the other features? Others are companies are not allowed to trade in, are allowed to trade in FNO segment. So future and option segment should be there. Okay, a company with come out with the IPO will be eligible for inclusion in the index if it fulfills the normal eligibility criteria for the index for a 3 month period instead of a 6 month period, right? So eligibility criteria of okay, so a company which comes out with a IPO will be eligible for inclusion in the index if it fulfills the normal eligibility criteria for the index for a 3 month period instead of 6 month period, right? So what is the difference here? Company should have a listing history. Okay. So from IPO point of view, it's 3 month, and from listing perspective, it should be 6 month. And 31st January and 31st. So this is index rebalancing, which Nifty keep on doing. So these days in Nifty 50, you will see not 50 stocks, but you will see 51 stocks, and there is a reason behind it. I'll because I'm sure one of you will go and try to see how many stocks are there. So just to tell you people, it is called Nifty 50. It is having 50 stocks only, but one company is having two stocks, two different type of stocks, and both of them have the eligibility criteria to get into Nifty 50, and that's why they are there. So it is called Tata Motors and Tata Motor DVR. So DVR is a differential voting right share, which Tata Motor came up with to for the sake of safeguarding the the voting power of the company. Just a second, guys. So yeah, so that's how. So since they are one company only, but two different shares, that's why if you do the counting, you'll find it 51. Otherwise, it's 50 shares only. Okay, let's move forward. Okay, so here, any guys have any issue till now about the index or anything? So let's open this sheet and also try to understand about the Nifty 50 companies, since I told you, and then we'll move forward. So as I told you about the weightage, so these are the companies ACC into cement, and the weightage is 0.41%. And these are the other numbers. I mean, beta, R2, volatility, monthly return. I mean, some of the things are impact cost is also there. So 0.03 is the impact cost, average impact cost in SEC. Similarly, you have 51 companies into different industry. If you people want, I can forward this sheet to you on email. I'll forward it. Right. So now what is this weightage thing? So let's say this company Reliance Industries is having a weightage of 7%. So what exactly it means that if Reliance is going up by 1% in a day, okay, it is gonna pull back 0.07% overall Nifty up. This is what the weightage is, right? So if a company is having high weightage, it will create higher impact on the movement of the overall Nifty. Is this a statement making sense to all of you? Any issue? So if I see HDFC also, it is having 7.53%. So if HDFC moves 1% or 2% in a day, and on another day Hindalco moves 2% up, which day Nifty will be higher? Obviously HDFC, right? So when I'm making these statements, does anyone have any issue here or any difficulty in understanding the weightage average price? Okay, very good. We got some questions from Ramender sir and Shruti. I'll answer that. But before that, I want to ask you people, do you have any question about the, because I'm almost done with explaining Nifty and index. Anyone have any issue? Any question? Your question will help other people also. Please don't shy asking questions. No questions? Okay. Yeah, Shweta, you have any question?
Yeah, I just wanted to know how do they decide what weightage a company should have in Nifty?
Yeah, very good question. So what do you think, what should be the weightage criteria if you were supposed to design Nifty, in Nifty, which is Nifty 50 as a prime index or basic index? How would you would have given the criteria? What are the factors you would have taken into consideration? Let's say tomorrow.
Maybe,
Yeah.
yeah, maybe the contribution that specific industry is showing to the sector.
Okay. What else?
I'm not sure.
Yeah, so which is fine. What else?
The market capital.
Market capitalization. Yeah, okay. So higher the market capitalization, the more weightage I should give it to that. So
Maybe.
yeah, maybe. So see, Shweta, there are many things. Okay, there could be hundreds of rule. So there is a very good paper on it. Okay, which actually tells why Reliance has been given 7%, why sometime back it was 10%, why it may get reduced to 6%, right? So if I start explaining the whole methodology, trust me, it will take more than 1 hour. But there are many factors, and even what you explained are also those factors, right? But it is based on the key factor which is called free float market capitalization, right? So free float market capitalization and market capitalization are two different terms. I would like to explain it here. Okay, so I told you people that if there are 100 shares of the company, overall shares, okay, and every share price is 1000 rupees, then the market capitalization will be 1 lakh. Okay, now let's say 20 shares is there with the promoters, and it is freezed not to trade. These are not tradable, right? Because these companies has been started by promoters. They kept on liquidating their power, but retaining those shares which they originally had. So the shares which are open in market to trade are called are open to trade are 80 shares in this case. So 80 into how much? 1000 is 80,000. So 80,000 will be free float market capitalization of this company. So when you said market capitalization, the only thing which we need to change there is free float market capitalization should be there. So there could be a company where promoters are holding 70% of the equity and those equities are non-tradable. Then there will be a chance that even the market capitalization of the company is very high, but they have been not given that kind of weightage into Nifty 50, right? So it is having again the same top to bottom approach where they see that which company is the market leader of that sector which is contributing the maximum into the economy, right? And that sector will have higher weightage, and within that sector which are those companies which are widely held by people means the free float market capitalization, right? So on the basis of these two criteria they start the formula, and then they take many things into the consideration. There could be hundreds of rules, trust me, I have seen that paper. It's very very lengthy. Okay, so so yeah, so that's what I'm trying to tell you, that there is a way to calculate it, and they have taken a good care of it. You can trust this for Nifty, that they have done a justice to it. Okay, you want to go deep into it, I will forward you that paper which I have downloaded. I'll forward you that in email also. You can chat me offline, or you can also go and download it. You may find it on Google. But yes, this is the answer of your question. Hope that that is okay. Or anything further you want to discuss in this?
No, that's fine. Thank you.
Okay, thanks. Right. So we have one question from Ramender sir. Uh, who decide the current price of a share? Is there a formula? So there is no formula for current market price, sir. It's purely based on the supply and demand. It's based on people want to buy something, So I got a watch and I want to sell at 1,000 rupees. You want to buy at 1,000 rupees, then 1,000 rupees will be the market price of that watch. Okay, if I'm not ready to sell it at 10,000, you are still ready to buy at 10,000, 10,000 will be the price. But the question will be always this: why would you buy at 10,000 and why would I sell at 10,000? This is where we will learn about three concepts today. One is book value, another is valuation, and then premium over that book value, which is the ongoing current market price of the share, right? So we will understand about it, but there is no formula to decide the stock price, sir. Okay, hope that answer your question, sir.
Yeah, that's fine. Good.
Yeah, thanks sir.
Hello? Yeah.
Yeah, thank you
Okay.
sir. Yeah, okay. And then Shruti has one question. Stocks are listed on both BSE and NSE. How does it make difference? So see, BSE is a little cheapest stock exchange. They charge you lesser fee than NSE because you have more investors trading into NSE. A broker has to pay big sum when they want to buy a license of broking from NSE than BSE. So from investor perspective, it actually don't make much difference apart from that impact cost which I was trying to explain. Since the liquidity is more in NSE, if you buy your shares in NSE, probably you will not have to give that much of impact cost which you can give into BSE. And again, that is again a chance. You may have the similar liquidity into NSE also. Okay, so this is one thing. Stocks are listed on both, so how does it make difference? So from your perspective, it don't make much difference, Shruti. Okay, you can buy it on BSE or NSE if you are a long term investor. It really will not make any difference. In both of the case, broker is going to charge you the same brokerage whether you buy it from BSE or NSE. Okay, and you I mean, from your perspective, it will hardly make any difference as an investor. From the companies who are going to list themselves on BSE and NSE, they have to make a lot of choices there. So listing on NSE is little expensive than BSE, so for them it makes a difference. Okay, and that is again a very detailed topic to understand. So when you want to go list your company, that time professionals will come and tell you what exactly is the difference from, but from the investor perspective you don't have any difference. Okay, Shruti, I mean, same stock is listed on both. Yeah, so same stock can be listed on both. And in fact, there was a case of Infosys where Infosys was also listed on, I think, London Stock Exchange. One of the India's first company got listed outside London Stock Exchange or New York Stock Exchange. I don't remember exactly, but this was one company which was listed outside India in a very very reputed stock exchange. So that people from there can also buy. Why it is recommended to trade with NSE? So the more liquidity, more options, more number of shares. So that's why you go and trade on NSE. That was another question from Shruti. So that's why I took time, explaining you people about the order book and also about the impact cost. From my perspective, I see only this as one of the thing why I trade also on NSE. So when I have to buy, I mean, I don't remember when I have placed a order on BSE, honestly speaking. Probably I have never. So one or two clients who have certain favorite stocks or they have done their own research, they would have asked me to buy one share from BSE and then I would have bought one for them going into the BSE. But I personally, for all the trades I have done, I have hardly, I have never in fact purchased anything from the BSE till now. So, but there are some companies who are listed only on BSE, you know. So Shruti, you had all these three questions. Is it okay?
Yeah, yeah,
All
it's
right.
perfectly fine.
So Raminder Singh is having another question. Can we trade shares purchased from say NSE and then sell them on BSE or vice versa? Yes, sir, you can do that. It happens. So your broker will facilitate you on this, but it is possible because at the end of the day, what is happening that you are buying shares. It doesn't matter from where you are buying. So when you are owning something, you can sell it. So it's something like buying okay, so in a real life example, buying a shirt from one store, and if it's tradable, selling into the another store, it's possible. I have seen this kind of transaction happening, but and and uh, and generally the people who do arbitrage on cross exchanges, they play with this trick also, right, where they buy on one exchange and sell on another exchange, and when the price difference come, they buy back on the other exchange and sell on the where they have bought. So these kind of arbitrage activity happens on cross exchanges. But as a simple investor, yeah, you can buy on BSE and sell on NSE. So I'm telling you this based on my experience. I have seen this happening, and that's why I'm telling you. But latest, if something would have got changed, I don't know. But why to take a chance? You buy at NSE, sell at NSE. Okay. So these were the questions, and now I'm lost where I was exactly. So yes, so we explained about Nifty. We took some questions about the index and Nifty, and just to repeat it, Nifty tells you where exactly market is going as a wholesome approach. So some shares would be going up, some shares would be going down. some sectors would be doing good, some sectors would be doing bad, but then you should know as a complete market where exactly it is moving, and that's why you create index. And Nifty 50 is the index of NSE, very very strong and powerful you know index which represent almost whole economy, because it has taken all the top 12 sectors from the industry, and within them all the top companies within that sectors. So that's why it is called, the sensitivity index also it is called. And it is Nifty 50 for NSE, which includes 50 companies. The counting would be 51 because of Tata Motor DVR inclusion. And Sensex 30 will have 30 companies, again similar structure, only thing is the number of companies are lesser. Sensex was established earlier. NSE came later into the picture. I think Sensex history is more than 150 years. How and Nifty or NSE history is 30-35 years. So this is all about Nifty and Sensex. And now we will go to. So see, till now what we have understood, we understood about economy, basic terms of the stock market, why stock market exists, and then the idea was always that when you know all these things, we have to take some action. That okay, fine, understood. Now what to do? I have to buy shares. Tell me how should I buy? This was the question some people had yesterday. So what is the philosophy of buying? So I would like to one volunteer to help me here. So can you guys tell me what is the philosophy of buying? So when you want to buy something, how do you take decisions? So Shruti, you asked many questions. Now you have to participate with me. So tell me, when you want to, when you want to buy something, how do you buy? How you take the decision of buying? Buying. What are the behavior which actually uh, you exhibit while buying, or thinking process which goes through your mind when you want to buy something?
Yeah, actually, I see the 5-year trend of that stock.
I'm not asking about the
Firstly,
stock.
the first,
I'm not asking about the stock. Anything. Let's say you want to buy mobile phone. You want to buy
okay, I'll check.
a new
Okay,
dress.
okay, I'll check it. Yeah, yeah. It's if it is a mobile, then
Yeah.
first I will be checking about its specifications. Like if it is according to me camera quality, then whatever other features are there,
Okay.
it should be in my. First of all, it should be in my range. First of all, I look for the range. If it is 15 to 20,000, 20 to 25,000,
Right.
then accordingly I see all the specifications. Then what all things are according to my requirement. Then after that, I take a decision to buy the thing like that.
Okay. And do you also see that you should buy it cheaper? If someone is selling at
Depends.
16,000 and someone is selling at 15,000, you probably buy from the 15,000 guy.
No, 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 no. I mean, if this much huge difference is there between 16 and 60, you are talking about 60 or 15 or 16 or 15?
16 or 15,000 even.
16, yeah, then eventually I will check for some quality aspects and all. And if it satisfies me,
Same.
then obviously I can
I
go for
mean,
15 also.
I'm talking about same phone. So these days you can see these kind of differences also, that e-commerce are
Yeah,
selling things on 20% discount than physical store, and we tend to order from there. That's how in fact the whole story of e-commerce has run till now, based on discounting, right?
yeah, then obviously I will buy for 15 only.
15
Why
only.
shall I?
Right. So what we
Obviously.
see, that we first see the value it is giving us, right? And the second thing, we see that where exactly we can buy it, at a good price. So knowing the price is very important, correct? So this is what we will try to understand here, that how the pricing affects the buying behavior. And another thing is like why we should be also careful about knowing the exact price, because when you hear about the stock price of Reliance as 1600, you are actually clueless. Why 1600 when it was to 1400 a few days before? 3 months back it was 1000 rupees, now it is 1600 rupees. Why? I'm confused, right? So you started with, I see 5-year trend. Now, you know forget about 5-year trend. You see 6-month old trend, and you see that within, so first 8 years Reliance were moving nowhere. It was ranging between 800 to 1000, and suddenly in last 6 months, from 900 it has rallied up to 1700, 1650, right? So everything goes out of the, the basic principle of understanding the valuation part, or understanding the price, that why exactly Reliance should be trading at 1600 or 1615. So for that, we need to understand valuation. So let's not complicate here that why stock price of Reliance is 1600 in last 6 months. We will see that why, what could be the factor it has gone there. But before that, let's understand something called valuation. So before explaining you people valuation, let me just tell you that what exactly is the industry standard on the valuation side. So there's something called DCF method, discounted cash flow, which most of the analysts use for coming to a valuation part. I have you know uh, dissected this DCF part into simple example, and doing some math with you people. So just bear with me for 5 minutes and try to understand few things. So let's say you have 1 lakh rupee, okay, and at the end of the day, it's investment. So you want to make money on your investment, and you have 3 4 options to do investment, pure investment. And what are those 3 4 options? One, you can buy gold. Gold prices also moves up and down. You can buy real estate, which you can't buy in 1 lakh rupee. But let's say there is one real estate which you can buy at 1 lakh, and then you can do it on fixed deposit. So fixed deposit is the only instrument which is going to give you a promise that 100%, if we are committing you a rate, will give you that much of return. Okay. Rest all three have fluctuation, so nobody knows what exactly the rate will be coming, but we can see the trend from the history. Okay. So let's say, try to understand valuation now. So let's say you have 1 lakh rupee, and you have two choices now. One is fixed deposit, which is promising you, and another choice is where there is no fixed promise, but you have seen the historical return, and on the basis of that, you are assuming that the similar return will be given for another 10 years. And on the basis of that, you are going to take a decision. So all three instrument, let's say, so let's talk some engineering now. So real estate, gold, and stock. So these three instrument, we mixed it up and made a machine. Okay. That machine, let's say, cost 10 lakh rupee. And the beauty of this machine is this was invented 5 years back, or and this 5 years they have been giving me. So every time I put some money into it, it gives me a return of 30% in a year, right? So what we have done here, we have made a machine, money making machine, out of three those investment instruments which are having a volatility in them. They are not promising you a fixed return, but what you have seen that from last 5 years, every time a person came there, put some money inside that, it has given you a 30% return in a year. पैसे को एक साल के लिए डाल के रखा, तो एक साल के अंत में 100 रुपया डाला था, तो कितना निकल करके आया? 130 रुपया निकल करके आ जाता है. Just visualize this. Okay. And now let's do some math. So you have 1 lakh rupees in your account. You deposited this to bank for 10 years. Let's check the FD rate. It's 6.25. So I can show you this. So this is the 5 to 10 years FD rate right now is 6.25%. For senior citizens, 6.75%. So I have taken 6.2%, 6.25%. So what is happening here? At 6.25%, value of the money will be 2,06,000. Any issue here? I have just used the same calculator which I used yesterday. The compound interest formula I have used. Hope everybody is fine with that. Right. So with the compounding method, what I saw that the money is 2,06,000 rupees. Okay. Now we have another choice. You again have 1 lakh rupee. So this is a mistake here, typo. And you deposit it to someone for 10 years, which is promising 30% return. You know, so depositing means we are giving it to that machine, which is going to give me 30% return. You know how the money will grow? Money will become 13,78,000. So at 6.25% rate, it's becoming 2 lakh. And at 30% rate, it is becoming 14 lakh. Hope nobody has any doubt here, have any doubt here. This is what is the power of compounding. So here this may look that it's just 24% extra difference, just 2% extra per month, but this final figure is very, very high. So if you use the compound interest formula, you will see that it's becoming approximately 14 lakh rupee. No doubt here, guys. If have any doubt, just stop me here. This another 10 minutes I think is important to understand valuation. Now, but why the other guy will promise you a high return? So obviously he will not promise. So this guy is not promising you. You deposited with him, but he's not promising you. But maybe he will he will make you, sorry, so some typo here again. So nobody will promise you 30% return, the promise part can be done only by the bank, which they are doing 6.25%, which is called the risk free money. So nobody will give you, a promise, but what he can show you is that he has a machine which is giving 30% return, and it is giving from last 5 years, and he can offer you that, boss, let's do one thing, you can own a piece of it. Okay, so this machine costs 10 lakh rupee, and we can put only 10 lakh rupees inside this machine maximum. You can own 1/10 of it, and on your 1 lakh you can make 30% return. So money making machine, buy it or not to buy it. So let's say you also know that that machine works. How? By seeing it perform from last 5 years, the way Shruti told that. See, she sees the historical performance. But here is another question: why the guy who owned this machine will make you a partner? He is also having 10 lakh rupees with him. Why he will offer you? Because he's having this machine. Other all machines are just giving 6.25%. So let's do some more math here. Okay, let's say that machine cost is 10 lakh rupee, and it makes 3 lakh rupees per year, which is 30% return. Now you want to become 1/10 partner of that machine. Why? Because you also want to make 30% return on your money by putting that money inside that machine. So how much you should pay to become 1/10 of the partner? 1 lakh, right? So 1 lakh, right? But idea here is, big question is, why that guy will sell you 1/10 partnership in 1 lakh rupee? Right? So let's say because he need money. So maybe he can make this machine bigger by doing more R&D, and D, and that's why he need that money. But he agrees to sell you that 1/10 partnership at 2 lakh rupees. So some arbitrary number came to his mind, and he say that, see boss, I'm giving you 1/10 of this machine which can make you good money, but I'll not give you in 1 lakh, I'll give you in 2 lakh. Now let's do some more math again. Okay, so the math says here, you have to take out 2 lakh rupees from your account, and you have two choice. One, place this money at 6.25% interest. Just a second, guys. Right. So now what is the choice you have? One choice is put this 2 lakh into fixed deposit, because anyway you're gonna give this guy 2 lakh rupee. So when you put 2 lakh rupees into fixed deposit at 6.25% rate, it becomes anything like 3.66 lakh rupee, right? Or maybe this number could be more. I think some calculation mistake. Let me see once. So what I'll do 2 lakh for 6.25 for 10 years, and I'll see what is the return is 3.66 lakh. So why 1 lakh was, so 1 lakh calculation was 183. So the other place had some mistake. So this slide is okay. Right. So your 2 lakh will become how much? 3.66 lakh rupee. However, here now you are owning that machine 1/10 part where you can put your 1 lakh rupee, though you have given 2 lakh rupee. So in both of the case, actually you have shelled out how much? You have shelled out 2 lakh rupee. But how the money will be made at what rate? So in both cases, you are placing 2 lakh rupee. Guys, let me know if I'm confusing you people. Okay, and here also you are placing 2 lakh rupees only. In this case, your 2 lakh rupees will give you a return at the rate of 6.25%. In this case, 1 lakh rupee will give you a return at 30%. Okay, so 1 lakh at 30% will make you 14 lakh rupee. Here, 2 lakh at 6.25% will give you 3.66 lakh rupee. So which is still a better choice? You gonna put your money here in fixed deposit, or you wanna buy this in 2 lakh rupees, something which actually worth 1 lakh? I would take this one, second choice, because still in both of the case, I'm shelling out 2 lakh rupees. Here I'm gonna make 4 lakh, 3.66. Here I'm gonna make 14 lakh. So do you have any question here in this example? Anyone? TK, are you with me? Puneet?
Yes, Kundan.
Yeah,
So TK, is it making sense?
Yes, yes, perfect sense.
Perfect sense. So you will also
Yep.
place your money here, right? Even though you gonna own just 1/10 of the piece, which actually worth 1 lakh, but you will look at the final outcome, which you see that you are actually getting 14 lakh after 10 years here, and you're getting 4 lakh approximately here after 2 years. So you will make a wise choice of going with this, correct?
Correct. Because even though the 30% appears only on the 1 lakh, but even on my investment of 2 lakhs, I end up making 14.
Correct. So in both case, you are placing 2 lakh rupee. Now this is called
That's correct.
discounted cash flow actually. Okay, so let's take some more example here. So yeah, Vipul, sorry, you are fine with it, right? Puneet, you
yeah.
okay,
So
okay,
yes, it is okay.
okay, good. So I take some time explaining this because sometime it becomes confusing. That's why I have taken that example of money making machine, because trust me, explaining you people DCF would be more complicated. So you just trust me there. Right. Now let's say there is another guy, you know, he have similar kind of machine again, another scientist. And this guy says that, boss, I have a machine which gives you money at 35% rate. Same example. That machine again can take a maximum of 10 lakh rupees inside it. And if you own a piece, 1/10 piece, you will be able to multiply only your 1 lakh rupee, but at a higher rate, 35%. And that's why now this chap is saying that, boss, but I will not share it with you if you don't give me 5 lakh, right? So now I'll do a reverse calculation on 5 lakh. So in this case again, what I'm shelling out is 5 lakh rupees. And in this case again, I'm shelling out 5 lakh rupee, right? So if I put my 5 lakh on fixed deposit with the same calculation, it becomes 9 lakh 16,000. On the other hand, this machine is giving me 35% return as a outcome, and it becomes how much? It becomes 20 lakh rupee. Wow. So we have three choices now. One, we can put this 5 lakh into FD and make how much? 9.16 lakh. Or we can put 5 lakh and make 20 lakh with this machine. I have one small question here with one of you people, and I will not move forward till the time you give me the answer. And I have a third choice where also I can put my 5 lakh and it will make some money for me, right? How much will be that money? Can someone answer that? So I have shown you three choices. One choice. So now, I have three choice. So my base capital has become how much? 5 lakh. Because I won't be able to participate in this choice unless and until I don't bring 5 lakh rupee. And now that I have 5 lakh rupees with me, I have three choices. One choice I told you, which will make you how much money? This choice will make you 9.16 lakh rupee. This choice will make you how much? This choice will make you 20 lakh rupees. I have another choice from the last sheet, right? That was gonna make me money at what rate? 30%. But now my eligibility criteria will be to put how much money? Can anybody answer? So I'm talking about this choice.
So, Kundan, then in that case, the question would be, is the other guy willing to sell you more than one tenth?
Yes, he is willing.
Then you can put, so up to 2.5 lakh rupees you can put in.
Correct. So let's calculate now. So 2,50,000 at 30% for 10 years calculated on. Now this is becoming 34 lakh rupee. Two lakh 50,000. This is 34 lakh rupee. So here you have another choice where you can actually put 2.5 lakh rupees on work on 30%. And you can make approximately 34 lakh. Any confusion that why you will not go with this option? Obviously not, right? We'll go with this option. So if we are number guy, pure number, we don't understand business, we are not gonna see anything whether this guy who is you know uh, running the machine in a certain way or using a inferior quality of machine which will actually not even last for 10 years may get broken in 3 years. Let's say we take every other subjective thing on side one side and not take them into consideration, and we have to purely go based on number. I don't see a reason any mathematician or a basic calculative guy who do basic calculation will not opt for this option. Hope I'm with all of you. Ramender sir, it's okay. Shruti, Sweta. So TK has told me that it is okay with them. Every other guy? Chandranshu, Puneet, Lalit.
It is okay.
It is okay. Okay. Shweta, Shruti. Looks like last 10 minutes was boring and people have slept.
Yeah, it's fine.
It's fine. Good.
Yeah.
Okay. Okay.
Can you go to the
Yeah.
hello? Can you go to the slide, please?
Yeah. Yes, sir. I'm here.
This last line, it should read you are placing 5 lakhs, not 2 lakhs.
Where? Here?
Here, where your where your cursor is. This
Right.
should be
So
5
yes.
lakhs, not 2 lakhs.
Yes, it is 5 lakh. That was a typo. So in that's what I
Yeah.
said. Now the game is of 5 lakh, right? Because I have to bring that into the picture if I have to take all three factors into consideration. So guys, you have understood
That's right.
discounted cash flow today. Okay. This is what is called the discounted cash flow. So you know you have certain asset which is gonna give you certain return. And how do you know that? Because you see that number from the balance sheet and profit and loss statement, which I'm going to explain you people now in 2 minutes. And there where you think that, okay, whether I have to buy it or not, I will do this basic calculation first. And then once I am done with this basic calculation, I'll see that certain things are cheaper because of certain reason or with no reason. So on the top of this, yes, the subjective analysis is also required. But from the objectivity point of view, from the maths point of view, this is how you have to do the calculation to understand the price of this stock, whether they are selling at premium or discount. So here only want to introduce the concept of book value and market price. So in this case, in example 2, book value of the company is, for one share, let's say this 10 lakh rupees company was having just 10 share, so every one share book value was 1 lakh rupee. But in this case, since he is agreeing to pay, agreeing to sell at 2 lakh rupees, and buyer is also agreeing to buy it, this becomes the market price, 2 lakh rupee. So 1 lakh is the book value of one share and 2 lakh is the market price of one share. And in this example, your book value remains same. How much? 1 lakh rupee. But your market price become 5 lakh rupees, because now the agreement is happening at 5 lakh rupee. So this is what is called the book value and market price of the shares also. So in a similar way, you have to come to know that what exactly is the worth of the company, actual worth of the company, and then when it is getting traded into the market, at what price it is getting traded. And for every extra 1 rupee, it will be called 1 rupee premium. So this case, market price is at 4 lakh rupees premium. In the other case, it was trading at 1 lakh rupee premium. So every time when someone tells you that at what premium the stock is getting sold from the book value, you will see the difference between the market price and the book price. And this is called the book price, where you know the actual value of the company. So this is what I wanted to explain you people on the from the perspective of valuation. And now we will move to the balance sheet, because there we want to do the calculation and actually understand कि कंपनी का अभी शेयर प्राइस क्या है और वो कितना प्रीमियम पे बिक रहा है. So there where we want to understand what exactly is the current price of the stock at book value from the balance sheet, and then we'll see at what rate it is getting sold. And if it is getting sold at premium, is there any kind of factor like this, whether they are a money making machine which is making money at 30%, 25%, 10%, or negative return, right? So what we have to now understand is two things: the actual value of the machine and at what rate that machine is making money. So in the company case, what we have to understand, what is the actual value of the company, and from the So which we will understand from balance sheet. So you have to connect these two dots, one balance sheet and another the profit and loss statement. I will not make it complicated by showing you the actual balance sheet. I'll take you to certain website which directly throw out the numbers. Okay, it will become very easy for you people, but before that we will understand the basic of the balance sheet, so bear with me there. Okay, so two things: one, we will come to know what exactly is the actual price of that company, and another is that through their profit and loss statement, what exactly is the rate of the return on the capital which is there on that company, or the value which is there on the company. So and then what we will do, that we'll do 3-4 exercises for different companies, and we'll see that out of those 4 companies, if we have to buy just one, which we will buy. We'll do this exercise today, so that will answer your question, Shweta, which you asked yesterday, कि कैसे पता करेंगे which price, at which price we have to enter or which price we have to exit. So to understand that, now we have to understand the balance sheet part. So what is balance sheet? So we have three kind of financial statements. Okay, one is called balance sheet, another is called profit and loss, and third is called, or the income statement, and the third is called the cash flow statement. Okay, I will keep you people only to balance sheet and income statement into this class, even in this whole course. Okay, and that should be enough to give you a good view about the market or the company health check. Okay, so before understanding the concept of uh, balance sheet, let's understand our own balance sheet, the personal balance sheet. I'll just take a minute. So before understanding the balance sheet, let's understand our personal balance sheet. So let's say, all hypothetical examples. So let's say me as a person, I have earned something in my life, and I made some assets for me. So let's say I bought a house, I bought a car, and at the same point of time, to buy this house or this car, I have taken loan from the bank also, right? So let's say I bought a house which I bought at 50 lakh rupees, and now it worth 2 crore. And then let's say I bought a car worth 30 lakh, and it actually having a worth of 15 lakh. So try to understand, one asset has appreciated, another has got depreciated, right? So that's what we will learn in balance sheet also, which is called depreciation. So, and on the other hand, I had taken a loan from the bank to buy these two things, house and car, and I took, let's say, combinedly a loan of 70 lakh. So I have two assets now, and that's it. I have nothing else which can be sold. Okay, nobody will buy my clothes, and the only thing which they will buy is my house or my car. Okay, so my house costs now 2 crore, and my car costs 2.15 lakh. So I have the asset of 2.15 lakh. Okay, I took a loan of 70 lakh, and I have been paying slowly, and till now I have repaid them, let's say 20 lakh. So I still have a liability of 50 lakh. Now, what is my total worth? So tomorrow, if I need money badly, how much money I can maximum have after liquidating these two things and paying my liability also? That will be 2.15 crore minus 50 lakh. So 1.65 crore is my total worth. So that's how you come to know also that what exactly is your worth. Now a company worth is not different than what a normal person can calculate his own worth also. So asset is something which you have, and the basic equation of the accounting lies on this basic principle of our basic principle of our common things which is there with us also, right? What exactly is the basic principle? The basic principle is very simple. I have something and I owe to some people. So what I have minus what I owe will be my worth. So that will be the value of the owner. In my case, 2.15 crore here, 50 lakh here, and 1.65 crore is my worth. So asset is something which you have, liability is what you owe, and worth is something which is what your value at the current price. So this is the basic equation of accounting which is used globally. The basic equation of accounting states what you have minus what you owe is what you worth. Okay. Now it is termed as many other things: worth, net worth, equity, owner's equity, shareholders equity. Why I've written these terms here? Because when I'll show you those, financial statements, you will come across these. So don't confuse between this. You go to Money Control or Reddit Money or any other website, or download the financial statement of any of the companies. These kind of things will be interchangeably used. Okay, all means the same, which is the value of the enterprise belonging to its owner. So this is the basic principle of the accounting. Let me remind you people, we are learning about balance sheet right now. Okay. So, but balance sheet presents the basic equation of accounting in a slightly rearranged form. So here what we saw, asset minus liability is equal to worth. Very easy to understand this by all the people from the math background. We all have math background because up to 10th we all have studied math. And all I have done is move the liability to the right hand side and made it the equation like this. Asset is equal to liability plus worth, right? So my asset is equal to my liability plus worth, simple calculation, right? So by definition, this equation must be in balance with assets equaling the sum of liabilities and worth. Fine. So this always needs to be balanced. It will naturally be balanced, right? So if you add an asset to the left side of the equation, you must also increase the right side by adding a liability or increasing the worth. Two entries are required to keep the balance. So two things can happen. One, right now my worth is 1.65 crore, and today after this class all you people deposited 1 lakh rupees in my account, and that's how I collected 10 lakh rupees more, and my worth has become more. So here what I'll add is my worth is now 1.75 crore, and that's why my total asset will be also increased by 10 lakh, because that asset of liquid cash will be also considered. So till now what I told you people, that all I have is one house, one car, but no bank balance. But just because you people are giving me 1 lakh rupees for this class, what I will have or what I'll gain is I'll add that 10 lakh rupees here, and my total asset will become three things: my house, my car, and 10 lakh rupees bank balance. So again this is balanced. So my worth has increased, my asset has increased. What other thing can have? I may buy another house. Okay, looking at my net worth, bank offered me that, boss, we can fund 100% to you. You buy another house of 1 crore. And I thought, okay, real estate is down, let me buy another house. So here, my liability will increase. Now the bank will give me 1 crore, which will add up here with the existing liability I have, but my asset will increase. So this is what we always have to do in a balance sheet. So when one accountant follow the rule of making the balance sheet globally, they used to they keep doing it, keeping the asset on the left side and liability plus worth on the other side, and they keep balancing it. This is the structure of the balance sheet. Okay, any question till now here, except the part that you people are not giving me 1 lakh rupee? Anyone about this structure of the balance sheet? It's all okay, simple. All right, guys, there's no charge. Let's move forward. What are the assets? So assets are everything you got: cash in bank, as I told you, inventory, machine, building, all of it. So as an individual, I don't have machinery or inventory or any other things. But when you have company, when you manufacture thing, you keep money into your bank account. You buy inventory.
Kundan,
Yes, sir.
TK here again.
Yeah.
Naive question,
Yeah.
something that my wife came up with right away.
Okay.
So the thing is that
Hey, hi Kundan, this is Bharti here. I'm also
Hi.
your batchmate.
Hi, Bharti. How are you? We are talking for the
I'm
first
doing
time.
good. No, I know.
okay. So the question is this: suppose today you buy a house
Right.
for 1 piece by taking a loan.
Right.
So as on date, the worth of the house is 1 crore.
Correct.
So your worth is 1 crore, your liability is 1 crore, and your asset is also 1 crore.
No, but
Is that balanced?
no, my worth has not increased. My liability has increased on the right side. Ha-
No.
so
Suppose you have 1 crore rupees.
correct.
So you took 1 crore rupees and you bought a house,
No, I have one.
and that one
So where I got this 1 crore from?
loan.
Loan. So loan will add up in the liability, right? Not, it will
Correct.
not increase my worth.
Okay.
So see, let's go back again to this. So what you did is the reverse calculation, but we have to think straight here, okay? And in order to think
Yeah.
straight, what we have to understand here is the definition of worth, okay? So let me go back to the same example again. I have one house and one car. House I bought at 50 lakh. It has become 2 crore. Car I bought at 30 lakh. Due to depreciation, it has gone to 15 lakh value. Okay, so the total, I don't have bank balance, so anything which can be converted into cash, right? So the total asset what I have right now is 1.2 crore plus 15 lakh, which is like 2 lakh 15,000. But when I said that I bought this house, I bought them on loan. Your loan is your liability,
Got it.
and the definition of the worth is what? So your definition of the worth is it will be calculated after asset minus liability. What you did is you said the moment you bought a house, your worth has increased. No, my worth will not increase because the definition of worth
Because
is
that is not value to the owner. It's basically
exactly, it's not value to the owner. Value to the owner will be calculated once you place asset and liability into the picture.
correct.
Correct. So that's why
Yeah.
I gave you that example of I may earn money. Okay, that will increase my worth. But taking loan and then buying a asset will immediately not increase my worth. But maybe after 5 years what will happen, that I have taken a loan at 6%, my asset has increased at a rate of 25%, right? So that extra money which I have earned, so by deploying my money at work into putting my money into that machine which is giving me a return of 25%, can increase the worth of mine after 10 years or 5 years or even 2 years. But at t equal to 0, my worth has not increased. Why? Because I have just taken the loan, which means I have included the liability, and with that liability I have increased my asset. It will not increase my worth. That's why I have explained, generally when people explain the balance sheet, they directly come here. Trust me, I I was taught this thing in college. I who were teaching this in college, and they took me here. And till last 5 6 years I had this confusion always, that when these people were telling me that you have asset on the left side and liability on the right side, and you have to match it, and it always used to strike me, it always used to confuse me, why exactly these people are telling me this, why I need to balance it. If I'm always balancing it, worth of the company is zero. So if asset and liability both are equal, it is zero. And most of the colleges, the people teach like this. But then I referred to some really good author, and there what I saw, that they have explained the basic equation of accounting first, and they have explained the value of the owner in terms of worth. This is very simple concept. But only thing here which is, on top of this, is here we are defining the worth first, right? So in your example, the worth has not increased. We got only two segment affected, one where the liability has gone up and my asset has also gone up. right? So worth remains the constant. And in the other
Correct.
case,
I think now I get it. Now I get it because it comes from an original equation where the worth is defined based on the two different variables
right,
and not as direct balance equation that we are looking at in the next slide.
correct, correct. So pure thing is asset and liability. Worth is the derivative of these two.
Correct. Yeah.
Right.
Yeah.
So
Got it.
my worth has not increased, my liability has increased, and my asset has increased. But my worth can also increase. Why? Because I can add up some cash by making some money in these 10 days. So I did a consultancy project. I got paid for that. Let's say 2 lakh rupee, right? Now this 2 lakh rupees came to the system and it increased my worth, right? Or this house which I have bought, it has given me extra return than the interest which I paid, and that extra income will again increase my worth because my liability will keep on going down and my asset will keep on going up. My 1 crore house may become 3 crore, and here my 1 crore loan will come down to 50 lakh because I have made money, some money by earning, keep on paying the loan. This has increased by a higher rate. The liability was there at a fixed rate of 7, 8, 9%, which is there as the house loan, right? So yes, the worth increases, and that's what the companies also increases. We'll see this into some sheets later on, but before that, we wanted to understand it, right? So this is how is the structure of the balance sheet, right? And this is how you keep on balancing. So either you increase your worth or you increase your liability, and then you match it with asset. All right, guys, all of you, good TK that you asked, because I also thought it, because if it can confuse me, I think I'm also one of you. It will confuse other people as well. So Shweta, Shruti, Ramender Singh, Rajendra sir, Puneet, Pragya, Lalit, Chandranshu, Bhudev, all of you okay, or all of you are slept?
Yes, sir. Okay. Fine, sir.
Fine.
Okay.
Okay. By the way, thanks for joining, Bharti. Hope you are in the class. We'll connect offline as well.
Yeah, sure, sure. I'm like not the active participant, but then yeah, I'm right there.
Sure. Thanks. Okay, so let's define asset into a little detail. So assets are everything you got, cash in hand. So as an individual, I told you what asset one person can have, but as a company, a company can have cash, company can have inventory, machine, building. So everything which they own is come under asset. Okay, some assets are also the rights you own that have a monetary value. So monetary value is one thing which is important. What are those rights? So when companies manufacture things, they give it to the distributor take those things on credit. They say that, okay, I'll push your product into the market, but then I'll not give you upfront money. I'll give you the money when the products are sold. So they give you, let's say they give you 1 lakh rupee, and they take the material or the final produce worth of 10 lakh rupee. So now you got a right to collect 9 lakh rupee from this guy after 6 months. Okay, that will be also your asset, which will be called account receivable. Let's not get very detailed into the asset things or the category of asset, what are the current asset or current liability, because I don't think our class will allow that. Okay, we don't have that much of time. If it interests this you people, I would suggest some good books. You can go through that to classify assets in smaller in more in a broader segment. But what I'll try to explain you people is the net worth of the company and the return at which that company is making money, so that you can choose it with some acumen, what you right now. So I'm assuming all people are you know the first hand investor into the stock market, or probably trying to understand this market, or trying to understand the valuation part, right? But yes, so something like account receivable is also part of the asset. Assets are valuable, and this value must be quantifiable for an asset to be listed on balance sheet. Okay, so Vijay Malia used to say that my logo or my brand name is itself 700 crore or 800 crore. And you know what he did after that, right? So it was never on the balance sheet, but there are these kind of frauds also, where people say that my name cost, my fame cost, my brand name cost, and they ask for the premium, and there you have to be very very cautious that whether you have to give that premium to a person like Narayan Murthy, or you have to give that premium to a person like Beer King Malia, right? And that's how you one judgment you have to always do. So assets are valuable and they must be quantifiable. Okay, what are liabilities? So any economic obligation of the company, so money that company owes to lenders, suppliers, employees. So what happens that you need raw material. You may tell your suppliers that, boss, you need to give me 6 month credit, but then you owe him. You have to give this money after 6 months. This is your liability. You have taken a loan from company. This is your liability. You have not given your salary for 6 months the way Vijay Mallya didn't give for the last 6 months for all the Kingfisher employee. It was a liability on the balance sheet, right? Okay. So generally it is categorized and grouped for presentation on the balance sheet by to whom the debt is owed and whether the debt is payable within a year or it's a long term obligation. So just I have included this 1 year term because this current asset and current liability is one category which I would like to explain you people. So any asset which can be converted in cash within 1 year can be called current asset, and any debt which you have to pay within 1 year will be called current debt. Just listen to it and forget about it. This is what all I can say, because there are so many other category, broader categories, or category on the lower level where the assets and different liabilities has been quantified. We will read about them in another class, ratio analysis, tomorrow. I don't think we'll be able to cover ratio analysis today. So today we'll put up some effort on learning ratio analysis, and day after that we'll learn about so guys, whomsoever is continuously doing this now, I see that it is not gonna be a 5 day course. It is gonna be 6 day course. One more day will be surely there on Saturday. So because we are lagging behind. Okay, so shareholder equity is a very special kind of liquidity liability. So when I explained you people about this money you owe and supplier, employee, and all this thing, there is also called shareholders equity that is also kept as a liability, but you never have to pay them in most of the cases. So what is shareholder equity? So when the promoters put his money in the beginning, when he came up with IPO and collected money, and that money came on the balance sheet, this is also a money came from somewhere, and it is also a kind of liability. But then it's a company owned by the same people, so those people never ask that money back. What they actually take is the share of the company, which is tradable in the market. So they are happy about it. So, but it is also a kind of liability to the company, because company is a hypothetical unit, right? Me, I'm a different guy. My company is a different entity altogether. So if I have given my money to that company, that will be called the shareholder equity money. And so my company owe that to me. They have to pay it. They should ideally pay it to me, but there's no point because they have given me shares. That share is tradable. So shareholder equity is again a kind of liability. Okay. So I explained you people about this. Now we will do a small exercise, because now you people know what exactly is balance sheet, what exactly is the worth of the company, and this worth is nothing but that 1 lakh rupee which you wanted to place at work in the example or the DCF method which I explained you people. So now bear with me, I'll open one website which I want you people to explore. I shown you yesterday also, I extensively use it. So here what I'll do that, yesterday someone take the example of Sun Pharma. I'll take the example of Sun Pharma only. Okay. So this is book value of the company. Hope all of you are with me when I say book value. It is the actual value of one share of that company. This is current price and this is market capitalization. So market capitalization is calculated by total number of shares into current price, and this is this number. It is fine, right? Okay. Now let's say what is this number. Now I need to open an Excel sheet. So here I'll do some calculation for you people. So current price is 491. CMP is 491. Book value is 151. Book value is 151. Okay. So at what premium it is being sold? This is the premium at which the share price is sold in the market. It should demand 151, but due to that factor where this is again having a machine which is making money at a better rate than 6.25, they are asking for a premium, and that premium is 340 rupees. So at what factor it is being traded? This by this. So at this ratio, so three times 3.25 times the market price is of book value. Now market capitalization is 1,18,000 crore. So actual worth of the company should we can get by dividing by this ratio. Is it okay, guys? Or I'm doing something wrong? So 1,18,000 crore, right? So 1,18,000 crore is the market cap of the share. And market cap is as per the current market price. Current market price is 3.25 times of the book value. So if I have to come to know to the net worth of the real worth of the company, this formula, which formula? This one, actual worth. What I have to understand is, what I have to come to know is that if I divide this by this factor, it will give me the actual worth of the company. Anyone have any doubt here? Which is like 36,000 crore. Okay. So here you just trust me that I'm doing everything right. It is a market capitalization which is based on the current market price, which is trading at 3.25 times of the book value. And that's why the book value of this is the book value of one share, and this is the book value of the complete company, which is approximately 36,000 crore. Now, should not we see this here in the balance sheet structure also? So see, here I'll show you something. So this is called quarterly result. Quarterly result is what? How much money they are making quarter by quarter. So June 2017, March 2017. So company is involved into doing manufacturing something which they will sell. And in the process of selling those things, there will be expenses. Those expenses will be what? R&D expenses in a company like Sun Pharma, cost of goods, employee, many other things, sales effort, marketing, branding, transportation, many other things will be there, right? So what they are doing, they have sold in this 3 month between March, April, May and June, is the sell was 6,208 crore, expense was 6,063 crore. So obviously this is their profit. Okay, now this profit is in percentage term is 0.2.34%. So here what we see that OPM is very low, and this is the reason the stock price has gone down. It's not a rocket science. Company was supposed to make money which they are not making. Okay, other income was 151 crore. What are the heads beside this is something we have to see in a detailed balance sheet, but right now we are seeing the profit statement, profit and loss statement. Now obviously this company is making some money, but company is also having a infrastructure like building and machinery which is getting depreciated year by year, quarter by quarter at certain rate, and due to that the value of the company is going down. So that will considered as a loss, and that loss is 346 crore. What in terms of depreciation, right? Now the interest cost is there. What is the interest cost? To run the operation, they have also taken a loan, and that loan has to be paid out and that loan has to be paid out, and that money is 109 crore. So again, that will flush out from the profit only. So what we can see, that profit before tax is how much? It's actually a loss, 158 crore. And then on top of this, government is there to whom they have to pay the tax, and that tax is 161 crore. So what we can see, that actually this company which was supposed to make money is actually losing money in the last quarter. We'll see the results of what exactly has happened in the share price as the reflection of this poor performance of the quarterly result, right? Okay. Now it is the annual result. So here you have seen the quarterly result. Here it is the annual result. What is the annual result? Annual result is the net profit is 5255 crore, 5255 crore TTM. TTM means on last four quarter. This is annual result. So between 2016 and 17, their profit was 7,000 crore. Here it was 4,500 crore. Again 4,539 in 2015. TTM means last four quarter. This, and this. So something like TTM is a more accurate figure than 1 year, because it tells you about the trend of the profitability. So these two sheets. So just bear with me for your research on this website only. It is an easy thing for the early age investors to have these data, crunched in a format where you can come to know the net worth of the company very easily, rather than getting into a balance sheet and making yourself lost into that. So here you understand this quarterly result, you understand the meaning of annual result, and you understand this TTM part. Okay, let's move forward and see the balance sheet. Now here you see left side and right side, or I would say this is right side and this is left side, how it should be placed in a balance sheet, are equal. Okay, but it has been made equal because on left side there is asset. If you people have forgot, I'll move to the you know balance sheet structure. On left side you have asset, on the other side you have liabilities minus plus worth. But what I'm actually interested into is I want to know the worth of the company, right? So I will calculate the worth of the company, and the worth of company will be this asset. This is complete asset on the left side. On the liability side, you have two kind of liability. One is borrowing, and another is other liabilities. Borrowing is the loan, and other liability is something which I explained you in the terms of account payable for your suppliers and many other people. So what exactly is your final worth? Your final worth is nothing but this: the reserves which is there on the the balance sheet, that cash, and the share capital, the initial capital being put by the founder or the IPO के through जो पैसा आया था, right? So can you see that this 36,000 crore and you add this 300 200 crore, this again become 36,600, 36,300 crore. We were doing this sheet. Can you see it's coming very much equal to that, here and there 200 crores, right? So this is the actual worth of the company. Now if this is the actual worth, what we will see that now this company is making how much money, right? This company is making 5,000 crore in 1 year. Let's place this number, 5,200 crore. Okay. So what is the percentage rate on TTM? So on TTM, if I have to calculate the rate of return, it will be something like this by this into 100. So this machine is giving money at a rate of 14.32%. Okay. So here one thing you people have to remember about the stock market, and this is something called the anticipation theory. Okay. So people anticipate a good performance from the company, and that's why you put your money there. But in between companies fail. Okay, in between companies rate of return goes down because changes into the business environment, because more competitor comes into the picture, because their own strength or the good people leaves the company. Many other factor could be there when a company performance can deteriorate. We have seen numerous examples there. So people put money on an anticipation that it will keep on doing well, but in between they may not do well, and that's why there is a drop in the share price. I'll show you in the example of Sun Pharma and 3 4 more example today. So what we can see here is this machine is making me money at 14.32%. Now let's take an example here and see that instead of considering this as 36,000 crore, consider this at 36,000 rupees. So I have one choice where I can put 36,000 rupees.
Sundar?
Yeah, okay, tell me.
So just one question, slightly deviant from the topic. You can answer it now or probably later on.
No, tell me.
There is another point that's made on that screener website which says dividend return is 0.17%. So is that also included in this 14.32% that you're calculating?
No, I'm not including that.
Okay.
But that needs to be included. I mean, to get a better picture, yes, that should be included. That it's giving, so as
because that is also the amount that is being given back to the investors, right?
Giving back to the investors. So I will add up it later, but at this point of time, I'll see what exactly will be the return. But very good point raised. So
okay, sure, thank you.
Yeah, thanks. So how to take this into consideration about the dividend payout is something I'll try to explain, but let me do this calculation. But good point raised, TK. So here what I see that I have a machine which will make me 14.32% on 36,000 rupees. Okay, and how much will be this number become in 10 years? Let's say I'm doing this investment considering next 10 years. So again, compound interest. So what I'll do, 36,000 annual interest rate is 14.23%, and calculation period again, let's say 10 years. That again, why 10 years? Because I'm assuming that there is no major disruption going to happen in 10 years in the pharma sector, which I could be wrong again. I'm just doing math. I'm not doing a subjective analysis of the industry here, but to make sure that yes, I am buying it for the long term, and I'm taking a number of 10 years here into the consideration because uh, somehow I know that most of the people who do this discounting cash flow thing, they take 10, 20 years kind of numbers into the picture, because most of the people who are invested, big time investors, they take a very, very long term view. Okay, so this 36,000 goes to become 1,36,000. 1,36,000 at this rate. Okay, I have two choice now. One, I buy this share, but when I will go to buy, it will come to me in 1,18,000 rupees and not in 36,000. Everybody okay with this, or some people have problem here? Go back to the same example. This example, that here this guy was ready to pay in 2 lakh rupee, which was the market price. Same thing I'm explaining here. Market cap is 1,18,000 crore. So I am gonna invest, let's say, one, you know, 1 by 1 crore, the one share out of 1 crore share, I'm gonna buy that, right? Which will cost me in 1,18,000 rupees and not 36,000 rupees, right? But it will be giving me a return on 36,000 rupees at a rate of 14%. So here, in this case also, money which I'm shelling out to get this return is actually 1,18,000, correct? And another choice what I have here is, because every time when we compare the return of our stock, we'll compare it with why to take risk if I'm already getting this risk-free return of 6.25%. So what I'll do that I'll have two choice. One, I put my money here, choice one, of 1,18,000 rupees, because market cap is 1,18,000, and get a return on 36,000 for 14.32%, which will make my money to 1,36,000. And then another choice I have is, I have this 1,18,000 which I'm gonna put here, which I was supposed to put here, but I'll not put there, and first see that what happens if I put it into fixed deposit only, right? So 1,18,000, 1,18,000 at 6.25% will become 2,16,000. 2,16,000. Better return, right? My money is better here. And this is most important, risk free. This is at risk, because what I have seen here, that what we have seen that this company has made a loss in the last quarter, and this is the first time which has happened in the history of this stock. See here, every time they have made profit, this is the first time they have made loss. So now I don't know why they are making loss. Maybe I need to go detail and understand about this company, right? What kind of changes has happened, what kind of, so basically in this case, they are mostly the exporter, the export company, and their market is US market, and they have new Trump policy is going to affect both IT and pharma sector, and that is the result. One of the reason why this has happened, because their sales has dropped. Your sales has considerably dropped. Your fixed expenses are still there, right? And that's why you are making a loss here. So if I go and do a basic calculation with the basic math which I have been taught in my 10th class, what I see that I will get, by investing 1.18 lakh rupee, I will get here 1,36,000, and here I'll get how much? 2,68,000, 2,16,000. So the math side of me will tell that, Kundan, go and invest your money in fixed deposit. Don't take a risk and buy the share of this company. Does it make sense, guys? That it could be one of the way to determine the price of the stock, whether the current market price is correct or not. If it don't make any sense, let's see this example more and try to see what it was 3 years back or 2 years back, what kind of money it was making, and that's why this stock has given really, really good return. So if you see the graph here, let's say 2006. So I'm sure 2006 quarterly result will be there, or the annual. So here we have annual result of 2006. So TK, till now again we have not taken the dividend part into the picture, because this dividend payout percentage is based on, it is not certainly 12% of the total profit. It is some other number. I'll explain you later on, because I'm little unsure that on which basis it is saying 12%. It should not be 12%, because what I know that there most of the companies pay overall 1 to 2% of the the market price of nobody pays more than that. 1%, 1.5%, this is the kind of dividend they get. So even if I add that 1% into the 14%, I don't think it's gonna beat the FD rate, right? So I'm not taking this dividend payout into the consideration right now, because with my own observation and experience, what I have seen, that 99% of the companies pay you dividend approximately in a range of 1 to 1.5%. So just exclude this factor and then try to understand it. Now let's see in 2005 what happened. 2005, this company was 1000 crore plus 94 crore, which is like 1100 crore, approximately 1100 crore. And what was their result? How much profit they were making? 400 crore. Now 400 crore on 1100 crore. is how much? It's this much. 400 crore on 1100 crore. Okay. So 400 crore of profit on a worth of 1100 crore company is something like 400 divided by 1100 into 100. So see, this is that machine I was talking about, 36% return, right? At that point of time, look at the rate at which this company was growing. So the better return a company is making, the premium it may demand is higher, but it will still justify the cost. So you always have to do this reverse calculation and see that whether you are buying something cheap or you are buying something expensive. And now this will come only after practice. So I would suggest you people that you do it with 3-4 companies and then try to see that what exactly is what exactly is the rate of return for the overall that company, and whether that price justify the share or not. And then later on you can do the subjective analysis also. So any question till now here, what I was trying to explain you people? Shweta, Shruti, Rajendra sir, Puneet, you understood this basic part of the balance sheet, assets, liability, net worth, total worth of the company, their quarterly result or the annual result, TTM, and then the cash flow part, where you can see that a company is making money at a very very good rate, and that the rate of compounding will actually make it a very very expensive company one day. Any confusion till now? So this was the basic valuation part actually, which one should know before analyzing any stock or the stock price, whether they are buying expensive or they are buying cheap. So now let's say if I have to, obviously we'll learn more things about creating the portfolio, and in that portfolio I'll also learn about how to hedge that portfolio. But to make that portfolio, let's say I have to include 2 pharma stocks out of 5 pharma stocks, right? So yes, we'll do the subjective analysis, we'll do which kind of management is running that company, but at the same time we will also see that some companies asking premium unnecessarily, a huge premium, or it is actually on a very very uh, uh, or it's actually justifiable premium, right? Because something which you understood now is there's something called book value and something called market price. So Ramendra sir, when you were saying is there a formula, price formula for the stock price, there's no price formula, but yes, you can come to a conclusion to understand what exactly is the book value. So if company tomorrow get liquidated, every shareholder which will get how much of money. So let's say if you have bought Sun Pharma today, and tomorrow due to some reason everything needs to be liquidated, how much exactly one person will get for one share is this book value of 151 rupee, right? So the higher the rate of return, the anticipation of doing that company and giving the return on the stock will be higher. This is what is the number game. Subjective thing we will learn into the ratio analysis. But before that, you people had to understand this basic valuation technique, cash flow technique, profit and loss, reading of profit and loss from this quarterly result, and taking out the net worth from the balance sheet. So I think I'm done for today's class. Anyone having
So
any?
Kundan, just
Yeah,
one last question or query. You just made a comment on buying expensive, or buying cheap, or whatever it is. So I understood the part where you calculated the rate of return. I mean the amount that comes after you invest, let's say for 10 years in the stock or in FD, and then make a choice on that. But
correct.
by buying expensive or buying cheap, what do you exactly mean? Like you calculated the percent return based on the profit it made to the valuation of the company.
Correct.
Uh,
So
so what do you mean exactly by buying expensive? I just want that one clarification.
right. So see, in this example only, uh, if I have to go and buy the share, okay,
Okay.
this share will not come in 36,000. This will come in
Correct.
one lakh
Okay.
18,000 rupees, right? But this 1,18,000 rupees will make me how much in 10 years? 1,36,000 only. So it is buying expensive, right? It is more
Correct.
expensive than FD. Now,
Yes. Understood.
yeah, now the market price may crash by 50%. Okay. And when it will crash by 50%, let's say the stock price comes to 60,000. Okay. Now, if it comes
Okay.
to 60,000, what I have to do that I have to invest only 60,000 rupees and it will make me 136,000. However, on the FD side, if I invest 60,000, probably in 10 years, all I will get is approximately 1.18 lakh rupee, which will be lesser than this. So
Okay.
cheap or expensive is nothing but a comparison, right? So comparison,
Okay.
and we do the comparison with which what? So we have two kind of asset class. One is called risky asset class, another is called risk free asset class. FD is the only risk free asset class, and we will always see and compare and see that whether I'm buying the stuff expensive than FD or cheaper than FD. So the current price, according to me, for Sun Pharma, even after this kind of crash, looks like it's expensive. So see, the book value is fixed, which is 36,000 rupees for one share if there are 1 crore shares, right? But the market price is 1,18,000 rupees. So if I become just a mathematician and just see things in black and white without seeing the subjective part, that okay, Kundan, this quarter they may have made a loss because they would have adjusted something in the balance sheet from the previous year. Next quarter they may come with a big bang and they may post a fabulous figure as the quarterly result. Every scenario will change. Why it will change? Because this 36,000 rupees will start making money at 35% rate, and that's how this will become a huge number, and that number could be 5 lakh rupee, right? And when it will become 5 lakh rupees, this 1 lakh 8,000 will become cheaper, 18,000 will become cheaper. So it's relative thing.
So it's more about trending and looking at the trends also,
Yes,
where where this will determine eventually what you're buying at or what you're. Right now, what we are looking at is over a 10-year period at the current valuation that they are providing,
correct.
which is a better option.
Yes,
This may change even tomorrow if something happens to the market.
100%. So see, there are subjective and there is objective part. What we are learning
Yes.
today is the objective part. How? With a cash flow statement. I mean, this kind of
Okay.
discounted cash flow, where we are trying to see that, boss, I don't know anything. So there are two type of teachers. One who says that, boss, I don't know. So one type of boss is there who says that, boss, I don't know. Your health is your responsibility. You were supposed to come at 9 o'clock in the office. I don't know whether you have a family problem, personal problem, whatever it is, right? So right now I'm behaving like that manager and try to judge my employees and saying that, boss, I don't know anything. This is your performance, 14%. I will take you on that. Whether tomorrow you become the exceptional performer in the team because you took this 3 days off and did some meditation in Himalaya, okay, I'm not going to give that damn. Do that meditation, come back after 3 years, then 3 months, and then I'll see how productive you have become. Probably that time I'll think that paying you 3 lakh rupees salary is cheaper. But right now you are looking like a liability to me because you are not coming to office even in time. So here, a company which is giving me 14% return is looking like a liability when I have to buy that company at 3.5 times of the book value.
Okay. So with today's numbers, with what we have seen, this
Right,
is what it is.
exactly.
The rest is subjective.
Rest is subjective, which we have to see.
Oh.
We will see
Oh.
that
Oh.
through so see, right now what we understood profit and loss statement, and we understood the balance sheet part to pick up the numbers to calculate the net worth. Now this has given me a rate. rate of return. Now, what exactly we will learn is the subjective part through ratio analysis. That is another aspect of the fundamental research, which was supposed to be covered today only, but since it took time, we will cover it tomorrow, the subjective part. But yes, before going to the subjective part, we should know the valuation part, we should know the rate of return and everything. This is what we tried to understood today.
Okay, super. Got it.
Yeah.
Thank you.
Thanks, TK. So Bhudev is having a question: how cash flow statement help for investors? So cash flow statement help investor in terms of, so see, Bhudev, as I told you in the beginning, there are three types of financial statements. Okay, one is called balance sheet, another is called profit and loss account or income statement, and the third is called cash flow statement. So you know, you come to know that. This is the profit or this is the net worth of the company, but then you also want to see that where exactly cash is moving from which section to another section and what kind of value it is going to create. So I wanted to skip this section and wanted to put you people here, but now that you have asked this question, I'll include it tomorrow presentation when I'll be explaining you people about the ratio analysis. So I'll explain that cash flow statement, link it with balance sheet and profit and loss statement, and obviously with the ratios. So we'll do it tomorrow, Budev. He asked the question on the chat. Okay. Anything else, guys? Raminder sir, Shruti, Sweta, you messaged me on WhatsApp. Did you message a question here? No, no question here.
No, no, no question.
But this is your WhatsApp, right?
Yeah, it is my WhatsApp.
Okay. So no question. All well. Okay. Thanks, Raminder sir. Okay, guys. Any comment on the mode of delivery or the pace or how it can be made better? As I told you, people, that this is my for this course, be an investor. It is the first group, and I'm looking for a lot of feedback from you people. So either here or one to one, you can give me a feedback. It will help me create it better. I'm planning to create better content and put it on YouTube and website so that more and more people can read, and we can have more clarity about the stock market for a lot of people. The intention behind this course is to educate as many people as possible to restore their faith into equity market. So your feedback will help a lot. Please keep giving that. So there where I want to conclude this class today. Thanks everyone. So I have to stop the recording. So anything anyone has to say, or should I uh, close the session? All well, guys? Okay. So if nobody is responding, I'm assuming no question. So yeah. How to pause it? Yeah. So this session is being recorded, but Hey, is anybody online who can help me if you know this? How to pause the session? Man.
Kundan, maybe Google can help you.
I did it yesterday. I have recorded that. It's just that not, popping up. So here we have
Maybe,
material.
maybe it will get automatically saved while you try to exit from this.
Yeah, I know that if I'll exit, probably it will tell me how to, save it. But then, I don't want to take that risk.
Correct.
I want to first see whether I can record it. I can close it here. It's showing this session is recorded. Anyway, now I'll close it. So in training.